You've probably heard that you need a down payment to buy a home, but in 2025, that's not always the case. Depending on your situation, you might be able to buy a home with $0 out of pocket, no down payment, and in some cases, no closing costs either. In this video, I'm going to show you exactly how buyers are getting into homes with no money down using FHA loans, USDA loans, and down payment assistance. We'll go over how these programs actually work, what the fine print says, and what to watch out for. Because just hearing zero down sounds amazing, but there are some real risks you need to be aware of. Let's start with the big idea. There's no loan program called the zero down loan. What you're really doing is stacking tools together, loan programs, grants, assistance, seller credits, to reduce your out-of-pocket costs to as close to zero as possible. So we're going to talk about three main tools: USDA loans, FHA loans with down payment assistance, and gift funds or seller credits that fill in the gaps. And I'll walk you through how buyers actually combine these things to buy homes with zero down even in today's market. Let's start with the most straightforward option, USDA. If you qualify, a USDA loan gives you 100% financing. That means zero down payment. It's a government-backed loan program designed for buyers in rural or suburban areas, but there are two main requirements you have to meet. The home has to be in a USDA eligible area, and your income has to fall under the USDA income limit for your county and household size. So this isn't available to everyone, but if you qualify, it's one of the cleanest ways to get into a home with no money down. Let me be clear though, zero down doesn't mean zero cost. You'll still have closing costs. There's also a 1% upfront guarantee fee that can be rolled into the loan and 0.35% annual mortgage insurance that's paid monthly. Still, USDA's monthly costs are lower than FHA in most cases, and because there's no required down payment, it's often the cheapest path to homeownership if the home and your income qualify. Just so I'm clear here, there are two types of USDA loans: the direct and the guarantee. The guarantee has the guarantee fee and annual mortgage insurance, and the direct does not. The direct loan is for low and very low income borrowers. I have resource links in the description you can check out to find out if you qualify for the USDA loan. You can check out my website, workwithdang.com, for free home buying resources like a mortgage calculator, quick start home buying guide, and a home buyer's course. I can help you find a real estate agent in your area. There's more information on my website. I make content like this every week. Please subscribe if you haven't already. Now let's talk about FHA. FHA doesn't offer zero down on its own. The standard down payment is 3.5% down, but FHA allows gift funds, down payment assistance, and seller credits. So if you're using FHA, the key is to structure the loan with help from one or more of those options. Let's start with gift funds. FHA allows the down payment to come from a family member, fiance, domestic partner, employer, or even a nonprofit. The donor gives you the money for your down payment and closing costs, and they sign a letter saying it's a gift, not a loan. The lender will ask for some paperwork, bank statements, and proof the funds transferred, but it's a very common setup. Down payment assistance programs are another option. These are usually offered by state or local agencies and nonprofits. Some are grants that don't have to be paid back. Others are second loans that are deferred, forgiven over time, or repaid when you sell or refinance. Most of them require you to take a homebuyer education class, and they often have income or credit limits. But when they work, they can cover your full 3.5% down and sometimes closing costs too. Then you've got seller credits. With an FHA loan, the seller can contribute up to 6% of the purchase price toward your closing costs. That can help cover things like your lender fees, taxes, insurance, and prepaid items. It can't go toward your actual down payment, but if you're getting that covered by gift or assistance, the seller credit can handle the rest. So here's how it all comes together. Let's say you're buying a $250,000 home with an FHA loan. The required down payment is $8,750, but your parents gift you that amount. Then you negotiate a $7,000 seller credit to cover most or all of your closing costs. Between the gift and the seller credit, you might be able to get to the closing table with very little, maybe even zero out of pocket. Closing costs are usually 2 to 6% of the purchase price. Or maybe you're using a down payment assistance program instead of a gift. Some programs cover both the down payment and part or all of the closing costs, either with a forgivable second loan or a true grant. And that brings us to the FHA combo loan. Some lenders offer a first and second mortgage structure with FHA, where the first loan is the usual FHA loan and the second loan covers your down payment. This is usually through a partner fund like the Chinoa Fund or the National Homebuyers Fund. These programs aren't grants, they're loans, but they're designed to work seamlessly with FHA. And depending on your credit and lender, the second loan may be forgivable after a few years or just deferred with no payments until you sell or refinance. So yes, FHA can be structured for zero down, but it takes more moving parts. You're not getting 100% financing from FHA itself. You're layering in help from other sources. Just make sure your lender explains everything in detail and you understand everything. Sometimes there can be hidden fees or terms that you're not aware of if you don't pay close attention. Now, before we go any further, let me say this. Just because these tools exist doesn't mean everyone should use them. Let's talk about what to watch out for. One of the biggest things people overlook is mortgage insurance. Both FHA and USDA require it. With FHA, there's a 1.75% upfront guarantee fee and monthly MIP of about 0.55%. With USDA, it's a 1% upfront fee and 0.35% monthly. This is insurance that protects the lender, not you, and it adds to your monthly payment. And just so we're clear, mortgage insurance doesn't protect you as the buyer, it protects the lender, because when you put down less money, you're considered a higher risk borrower. So mortgage insurance is there in case you stop making payments. It helps the lender recover their losses. It's basically the price you pay for being able to buy a home with a small or zero down payment. The other big thing people miss is equity. When you put little or nothing down, and especially when you roll in the upfront fees, you're borrowing more than the home is worth on day one. So if you need to sell or refinance in the next couple of years, you might not have enough equity to do it. In fact, you could end up underwater, meaning you owe more than the home is worth. And just in case you don't know, equity just means how much of the home you actually own. If your home is worth $250,000 and you owe $240,000 on your mortgage, you've got $10,000 in equity. The less you owe, the more equity you have. But when you buy a home with zero down and roll in the upfront fees, you're starting off with very little equity, or in some cases, none at all. And that can make it harder to sell, refinance, or build long-term wealth if the home's value doesn't go up quickly. This is especially important in markets where prices aren't rising quickly or might even dip. If you're planning to move in a year or two, zero down might not be your best bet. But if you're planning to stay put for a while and want to hold on to your savings, it can absolutely work. You just need to be smart about how you do it. Another risk is relying on assistance programs that come with strings attached. Some down payment assistance programs require you to stay in the home for 5 to 10 years, or you'll have to repay the assistance. Others come with higher interest rates to offset the cost of the program. So even if you're not bringing money to the table, you might be paying more every month. Always look at the total monthly payment, not just the down payment. Also, seller credits aren't guaranteed. In a hot market, you may not be able to get the seller to cover your closing costs. These deals work best when the home's been sitting for a while or the seller is motivated. It's all about timing and negotiation. So when does buying with zero down actually make sense? It makes sense if you've got steady income, manageable debt, and a plan to stay in the home for a while, but your savings just hasn't caught up yet. Maybe you've been paying rent, student loans, childcare, you're doing okay financially, but coming up with $10,000 or $20,000 out of pocket just isn't realistic right now. It makes sense if your family is able to help with a gift and you've got a lender who knows how to structure everything properly. And it makes sense if you want to hold on to the money you do have saved, so you're not emptying your account just to close. Because let me be real, these programs aren't for people with absolutely no money. They're for people who want to get into a home and still have money left over. That way, if a life event happens, if something breaks in the home, if you need a cushion, you have one. In a perfect world, I tell everyone to save 20%, get a conventional loan, and skip mortgage insurance altogether. That way you avoid extra fees, start with equity, and have more flexibility down the line. That's just not an option for most first-time homebuyers right now. That's why these programs exist. They're not perfect, but if you use them the right way, they can get you into a home without draining your savings. If you want to learn what loan is the best fit for you, check out this video. Please like, comment, and subscribe. That motivates me to make more videos.